Dear investors, welcome back to Market Ka Gyaan. I am Narendra Solanki. Today, we will start with a new topic, which is on how to value a business. Let us just start. If you invest based on ratios alone, you do it wrong. Yes, you feel surprised, but it's a harsh truth. But you need to know how to properly value a business. Here's why ratios fail and how to understand and value a business. But before that, don't forget to click the bell icon and hit the subscribe button. So let's start. Every business is different. It operates in a different environment, it operates in a different industry. Within the same industry, each business operates in its different cycle. Some are new, some are old, some are somewhere in between a mature cycle, some are early into the cycle. So ratios can't tell that story and will give you wrong feeling of safety and security in understanding. They can offer a starting point, but for many businesses, they are insufficient. Ratios generally works well with large businesses which are very large and businesses that are very mature, and already there are hundreds and hundreds of investors who are following those businesses. It's very difficult to outperform that kind of market and that kind of business based on ratios alone. So you need to understand each business very differently on its own merits and analyze the overall business for those companies. So let us see how to do that. So there are basically few pointers which we would discuss. First of all is individual valuation. You need to understand businesses on a deeper level. There are businesses that work with a lot of leverages, for example, and it's part of their competitive advantage. So if you use a general debt equity ratio for an over leveraged businesses, you might miss out on that kind of companies. So that's why you need to value every businesses individually. Also, there are many businesses that seem unprofitable, but they have built tremendous earnings potential for the future. So these kind of businesses also may not be falling on the right side if you use ratios alone. There are companies that need high cash reserves and others that don't. So there are various nuances which ratios alone can't tell you, and that's why you need to have individual valuation and analyze individual aspects of each businesses at a deeper level. Gain insight into different industries. Over time, you'll know how different companies and industries work. Then you'll know what to look for and how you can value businesses. Ratios can be used in doing a deeper valuations, and then they may prove compatible in that kind of analysis. Use them for screening and finding ideas. Then go for deeper and understand the businesses. So that is the crux how you find a multi-bagger and can outperform the market at a much bigger scale.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.